Joining us now for more analysis of today's Fed decision, we're happy to have with us Robert McTeer. He's former president of the Federal Reserve Bank of Dallas, and Russ Kosterich, global chief investment strategist at BlackRock. Gentlemen, thank you so much for joining us on this big day. Bob, let me begin with you. So QE is over. How do you think the economy does from here? Does it continue to grow or does it stall out?
I think it continues to grow. We're no longer adding stimulus, but stopping QE doesn't take any stimulus away. The Fed's balance sheet is still intact, and there are a lot fewer bonds on the market because they're owned by the Fed than there would be otherwise. So the effect of the stimulus will still linger.
And how much does it grow?
Well, I think at the very least, the 2 to 2.5% it's been growing. I would think probably up closer to 3 by now.
So, Russ, stocks were in the red in reaction to all of this news today. Not by a whole lot, but they were on the downside. What is the market response?
I think the market response was fairly muted. Stocks were down a bit before the announcement. They actually recouped some of those losses. Yields ended just about where they were this morning. So not a lot of reaction. Most investors expected QE to end. If anything, I think people were a little bit more interested in the Fed language than the end of QE, which was widely anticipated.
So what happens with the markets going forward from here, Russ? Do you see more volatility, less volatility?
I think we see modestly more volatility. I do believe that stocks can move higher. Valuations are not cheap, but they're reasonable. Fundamentals are relatively sound. But what is likely to be different is we're probably moving into an environment in which volatility is going to be somewhat higher than the very low levels we've had the last couple of years. And arguably, we've already had a taste of that since the start of September.
You know, a lot of what's going to happen in the markets, Bob, is going to depend on what the Fed does with interest rates. You served in many of those meetings where decisions were made about raising interest rates. What do you think? So you know how the Fed decides these things. So what do you think the Fed is going to do? When are they going to start raising interest rates, and by how much on the first move?
I'm guessing that it'll be in the middle of next year, somewhere around July when they start. And I believe the first move would be to go to 0.25% on the Fed funds rate. It's now considered between 0 and 0.25%. So I think they would start with 0.25, and they would go slow, and they would make it clear that they were going to go slow. We're not going to have high interest rates anytime soon.
Russ, is that how you see it? And how do you think the markets would respond to that plan?
I think that is it. I do believe it will be a very slow process, given the fact there is not much inflationary pressure. And this is pretty much what the markets are discounting. If you look at where expectations are, somewhere next summer, next fall, we're likely to see the start of that tightening cycle. And I think the key thing for the markets is assuming that tightening cycle is happening in the context of a stronger U.S. economy, better growth, then I think stocks can continue to move higher despite having somewhat higher rates.
Let me ask you this too, Russ. How important is all this news coming out of the Fed today for individual investors? Do they need to make changes in their portfolios, whether we're talking about stocks or bonds?
Well, you know, it's an excellent question. I think the short answer is no. First of all, as we said before, most of what happened today was largely discounted. And I think for most individuals, the good news is we're moving into an environment which should be closer to normal, where the market is more driven by economic and company fundamentals than by every utterance from the Fed. So I think for most investors, they should keep to their investment plan. Nothing that happened today should really lead you to change that.
Bob, we heard from the Fed today saying that they're seeing substantial improvement in the job market. We're getting the next jobs report in about a week or so. Do you think we're going to see a continuing trend of robust hiring with the unemployment rate coming down?
I think so. The new claims data in the last few weeks have been fairly encouraging, and we now have several months of over 200,000 new payroll jobs. So it probably won't be as good as the September report, but I think it'll be pretty good.
And Russ, is that what you see? And also, can you give us real quickly what you think your year-end forecast for the Dow is going to be?
Well, we do think we're going to continue to see improvement in the labor market. Again, we've seen an environment in which initial jobless claims will remain low. That should be associated with 200,000 or better monthly non-farm payroll. I'll give you some views on the S&P if that's all right. We do think that stocks will make some modest gains for the remainder of the year, with the S&P 500 ending probably somewhere between about 2000 and maybe a bit better than that, maybe about 2020.
All right. Thank you so much, Bob, Russ. Really appreciate you coming on the program.
Thank you.
We've been speaking with Robert
Thank you.
McTeer, former president of the Dallas Federal Reserve Bank, and Russ Kosterich with BlackRock.